2/3 of 126 million households have less than $100,000 saved for retirement.
What advice would you give millennials or people just starting out in the workforce?
Well, so a lot of people, when they're saving for retirement and they get access for the first time, they're given this employee benefit and say, you can save for retirement. And you say, that's great. What should I invest in, right? And typically what people do is, because they're not so sophisticated about money, they'll use something, they call it 1/n. If you have 10 funds in your 401k investment option menu, you'll invest in all 10. You'll put like 10 cents in one and 10 cents in another, right? Which is not really a great way to do it. Right. So my advice is, especially if you're not yet sophisticated about investing, is to maybe use a target date fund. So that's a kind of fund, it's an all-in-one fund. It might invest in 10 mutual funds, and you don't have to worry about asset allocation. It does it for you, and you don't have to worry about rebalancing. It does it for you. All you have to worry about is your anticipated year of retirement. So if you're in your 20s or 30s, it might be the 2060 or 2065 fund. And that year is matched to your anticipated year of retirement. And when you're starting out, that's as good as any fund to invest in when you're just starting out, and you might not have any other assets. When you get older, you want to be more sophisticated about it, right? You might have other assets in a taxable account. You might have money in a traditional 401k, and then you'll want to start asset allocating based on all your investable assets, because at that point you want to avoid duplicating your investment.
More sophisticated.
A little bit, yeah.
For now, we can be more aggressive.
Well, so here's the thing about aggressive versus not aggressive, right? When you're younger, people typically say you can invest more aggressively because you have 30 years to go through 4 or 5 market cycles. And that on average, historically, large cap stocks return 12%, or small cap stocks 12%, and large cap have been 10%, and bonds have been 5%. And so that you have the benefit of time, right, that you could invest in more aggressively when you're younger. And as you get closer to retirement, you want to invest more conservatively and be more safely invested in less risky assets, maybe more bonds than stocks.
I gotta ask you, a lot of my friends, they have 401ks, and then they constantly tell me like they don't want to be investing in the market, and it's kind of frustrating because I don't know how to explain to them, when you have a 401k, you are investing in the market. Can you explain that a little bit more?
Well, so yeah, I mean, the hard part is, I think what happens is people don't want to lose money, right? More often than not, I hear someone say to me, or you think back to the lost generation that we just had a little bit ago. A lot of people were investing in 401ks for 10 years, and at the end of the 10 years, they actually had less money in their 401k than they had put in, right? And that discouraged people from wanting to invest, right? Because it's risky, right? So I think what you have to tell people is, it is risky, but the alternative is to invest in things that are less risky. And that doesn't necessarily bode well, because you're exposing yourselves to other risks, right? In the market, you're exposed to market risk, and that's volatility, and that means you could lose money. If you invest in things that are safe, well, you're going to be subject to the, inflation risk, right? And so what you're going to do is have your money earn less than what inflation is, which means that you're actually losing money, right, by investing in safe things. So you want to strike a balance, right? There are all these risks that you have to manage when you're investing, and you have to sort of say, I understand the risk, and the risk here is over 60 years, markets will go up 50%, down 50%, up 30, down 20, whatever it is, but on average it'll be 12 or 10% if I'm fully invested in the stock market. So you have to be able to say, I can withstand that kind of volatility. Now people also, I'll say this too, I'm not a big fan of risk tolerance questionnaires. People always say, I'm going to fill out this questionnaire and it's going to label me as an aggressive, moderate, conservative, safe investor, right? Well, the point of the matter is, it doesn't really matter whether you're an aggressive investor or a moderate or a conservative, right? Because if you have 40 years of investing to go through, well, you've got time to be an aggressive investor, but you have less time to be aggressive when you're in your 60s. So worry less about your tolerance for risk and more about educating yourself about the kind of risk that you face when you invest in the market.
One thing that's new in millennials are these apps like Robinhood or Acorn or different things like that. What do you see that doing for millennials that are trying to save, or even towards retirement, or just saving in general?
Well, so on the one hand, I think it's great. Things like Robinhood are introducing, I have a son he's 22 years old, and he introduced me to Robinhood because you could get a free stock or something. I forget what.
There's a couple free trades.
Free trades, whatever it might be. And so instead of me having to teach him, as much as I tried to teach him about investing, Robinhood, disenfranchised me, right? Disintermediated me from having to teach him about investing. So, to Robinhood's credit, to YouTube's credit, there's things that are happening that are teaching people about investing, and I think that's good. There was a very great book written many years ago in the 1920s about the difference between speculating and investing. And for many people, what they're doing is speculating, right? They're not investing, right? They're not taking the time to think about price-earnings ratios. They're not taking the time to think about macroeconomics. They're just saying, oh, my friend, they said Home Depot was down and now it's a good buy, or Nvidia was down and now it's a good buy.
Day trading versus investing.
Right, and they're just sort of like, they're going to a casino. But, the market is not a casino, right? It's really a place where, you can make lots of money, certainly, but you can also lose lots of money, as your friends have. And so the better thing to do would be to become, smart, right? I write about retirement folks who are largely on the precipice of retirement, and I called my readers students because they really care deeply about getting it right. And I think young people should feel the same way about investing. Care deeply about getting it right and less about maybe making money.